Thank you all for being here in this really cool space with a lot of news being made here today. I'm Giancarlo, former chairman of the U.S. Commodity Futures Trading Commission, and I'd like to talk to you today to give you maybe just a different perspective on crypto and distributed ledgers and Bitcoin and this entire technology. What I want to begin by doing is just sort of to get a sense of where we are, where all of you are, by just asking a few questions, beginning with what is crypto? And as you'll see as we go along, I'm going to use crypto as a shorthand for this entire innovation of distributed assets and tokenization, et cetera. So when I do this, I often ask what is crypto? And one of the answers I get is a new speculative investment asset class. Basically, is Bitcoin up today or is it down today? Is Ethereum up or down? What about meme stocks? What about Dogecoin and others? The vision is that people often see crypto in terms of trading markets. So I might ask you, does that resonate with you? Would you say you see crypto in terms of where Bitcoin is trading today or tomorrow? No. Others? Okay. How about a faster and more efficient means of payment? The ability to send money around the world the same way we send a photograph. How about the world's first digital commodities and securities? A few nodding heads. How about a form of gambling for young and naive investors? I would say every hand almost always goes up on that one. And perhaps all of the above. Well, I want to posit to you something different, a different way of seeing this innovation. And that is a series of algorithmic protocols to record and confirm on digital networks the holding and transfer of things of value. Put it another way, a new architecture for who owns what and who's transferring what to whom. A new way of recording it. And I'm going to go through as I talk today. I think maybe by the time we're done, that will resonate more and more with you. It's new architecture for the holding and the transfer of things of value. Aaron was talking a few minutes ago about the recording industry and the music industry. Who does this song belong to? Who has access to it? How do we record those things? That's just one, those are things of value. How do we record them on digital networks? So briefly, who am I? I came out of Vanderbilt Law School in 1984. I practiced law for 20 years. I then went into business in the year 2000 with a group of entrepreneurs that were building some of the world's first electronic trading systems for trading a type of complex financial instrument called a credit default swap. And we were very successful at that. These electronic platforms that we built quickly expanded around the world. We took the company public in 2005. And by 2008, our platform, a company called GFI Group, had about 80% of the credit default swaps market trading on our platforms. Now, a few years later, the 2008 financial crisis came, and I got involved in what eventually became the drafting of the Dodd-Frank bill, at least the portions having to do with swaps. I then went and served as a federal regulator, first appointed by President Obama, and then reappointed by President Trump to serve as chairman of the agency. And I'm very proud of the fact that both times I was unanimously confirmed by the Senate, which proves probably that most people don't know what credit default swaps are or do, or that I hadn't pissed off enough legislators during my first 2.5 years in Washington. I then went on to write a book about my experience, and today I'm a business advisor and investor advisor in crypto. But I want to go back to 2008. In 2008, I remember distinctly getting a call from the Federal Reserve, and the call sort of went like this. Hello, I'm so-and-so senior official at the Federal Reserve Bank of New York. What do you guys do again? Oh, right. What we do is we are about 80% of the market, about 80% of the credit default swaps market trades on our platform. Oh, right. That's right. I remember you told me that a few months ago at a reception where we first met. So what's happening in the market? Now, this is about a week before Lehman Brothers collapsed. And I said, well, it's pandemonium in the market right now. The way credit default swaps trade, they trade at a spread to Treasury securities. So the higher the spread, the more the perceived risk of failure of the institution. And at the time of the phone call, Lehman Brothers was trading about 800 basis points over treasuries, which meant they were in serious troubled territory. And so I explained this to the representative of the Fed, and he said, "This is absolutely fascinating. Is it really that bad?" I said, "It's worse than that bad. Not only if you can buy protection against the failure of Lehman Brothers, will you pay this extraordinary amount? Nobody's willing to write that protection." And in fact, I didn't know when it would collapse, I basically said, Lehman Brothers is a dead man walking. And that was about 10 days before they eventually collapsed. We knew on our platform how bad the environment was on Wall Street. At the time of Lehman Brothers' failure, the federal authorities believed that there was about $400 billion of protection written against Lehman Brothers. That meant if Lehman Brothers failed, they believed that the other banks would have to pay out $400 billion. And they effectively extrapolated and said, well, if it's $400 billion on a failure of Lehman Brothers, it must be $800 billion on a failure of Morgan Stanley, and perhaps $1.2 trillion on a failure of JP Morgan. And with that extrapolation, they came up with the TARP program in the same way a fire brigade, if a house is on fire, wet down all the surrounding houses around so they won't go on fire. The TARP program basically flooded all the other banks' balance sheet with printed dollars so that they would not go belly under. Well, that figure of $400 billion struck me at the time as wrong, because I knew from our place in the market that all those banks, after they'd write protection, would then reinsure their protection. So if the gross amount was $400 billion, the net amount must have been much lower. And over the next few years, eventually I went to the CFTC. I contacted Bruce Tuckman, a professor at NYU, and I said, "Bruce, the net figure has got to be much lower. What do you think it is?" And he said, "Well, off the top of my head, I bet it's less than $100 billion. I'll do some math." Well, the math turned out to be that a failure of Lehman Brothers would have triggered less than $9 billion in exposure. $9 billion could have been a check written by the Fed, or they could have let it fail, or they could have allowed it to be sold, all of which would not have caused a financial crisis. At heart, the financial crisis was a lack of visibility into the true exposure of one Wall Street bank to another Wall Street bank. And as I read the Satoshi Nakamoto white paper, the famous white paper that began the Bitcoin blockchain, and as I read up on it, I had this eureka moment sometime in 2011, where I realized that if all of those credit default exposures had been written on a blockchain, we might not have had a 2008 financial crisis, because we would have known in real time the real exposure and not the perceived exposure. And that's when I fell down the crypto rabbit hole. You talk to anybody in crypto, they have all their unique stories. For me, it had nothing to do with Bitcoin as crypto. It had to do with crypto as architecture. If the architecture of the financial market, the architecture of Wall Street, had been written on a blockchain in 2008, we might not have had the financial crisis that we had. And over the next few years, Bitcoin continued to grow. I joined the U.S. Commodity Futures Trading Commission as a commissioner in 2014. And not long after, in September of, that date's wrong, that should be 15. In September of 2015, we declared Bitcoin to be officially a commodity under the CFTC jurisdiction and not under the SEC jurisdiction. And over the next few years, we watched the price of Bitcoin explode. 2017, the first year of the Trump administration. Why do I say that President Trump may well be the first crypto president? Well, because we at the CFTC created Washington's first dedicated crypto and financial technology resource lab, CFTC. It began in a few months of my becoming chairman of the agency, and we instructed Lab CFTC to understand everything they could about this new innovation. At the time, we were thinking, how can we apply it to traditional Wall Street products? Little did we know we would apply it directly to crypto within a very short period of time. We created the first Chief Financial Innovation Office and Market Intelligence Officers in the federal government. We wrote written primers on crypto innovation and published it for the industry, for people outside the industry that didn't know what crypto was at the time. And we began doing synthetic Bitcoin mining in the commission boardroom in the summer of 2017 because we wanted to understand what crypto was, and the only way to understand it is we did some mining ourselves. And in December of 2017, the CFTC greenlighted the first crypto derivative product, not just in the United States, anywhere in the world. It was the world's first regulated crypto marketplace, crypto derivatives. It ensured, and this is important, dollar pricing of the world's first digital commodity. And just an aside, one of the underpinnings of the US dollar and its reserve currency status is that most of the world's natural commodities, oil, gold, wheat, corn, soybeans, are priced in dollars. And that supports the dollar because the world has to hold dollars to buy those instruments. We at the CFTC wanted to make sure that the world's first digital commodity, Bitcoin, was priced in dollars, hence the green lighting of the Bitcoin, because pricing of commodities is not set in the spot market, they're set in the futures market. The price of gold is set in the gold futures market, not at the jewelry store. The price of oil is set in the oil futures market, not at the gas pump. We wanted to make sure the world's first Bitcoin futures was priced in dollars here in the United States. And it became the basis for eventually the SEC's allowance of Bitcoin ETFs. All right. I now want to back up a little bit and talk about why I believe crypto is really about architecture. And I want to talk about the history of digital networks. The first wave of the internet came about 30 years ago. The key protocols, let me back up for a second. One may argue that the internet owes its responsibility to the development of microprocessors, semiconductors, and the construction of personal computers, the ability to take what previously had been giant mainframe computers on college campuses and military installations and reduce them down to small personal computers. But I would argue the real breakthrough was less about hardware than it was the development of software. Key protocols like TCP/IP and HTTP and HTML enabled the creation of the internet to allow those PCs to talk to each other. And the result of those computers talking to each other is all manner of information sharing and all manner of social change, whether it be from music to television, to retail shopping with Amazon and eBay and local transportation, Uber and travel and leisure and video and photography and communications, social networking and business meetings and so on and so forth. It was the development of those key software protocols that really led to the social change. And the next wave of the internet is called the Internet of Things. Ever smaller digital devices talking to other digital devices, allowing the automation of transportation, the way we drive and look at maps and get traffic information and others. But once again, it's less about the hardware. It's all about the key protocols, Bluetooth and Wi-Fi, that allow these small devices to talking. So what's the analogy of that to the next wave of the internet? Well, the next wave of the internet, the one that's upon us now, the one that is crypto, is an internet of value. And once again, it's about key protocols, but this time the protocols are BTC for Bitcoin and ETH for Ethereum and Solana and Cardano and USDC. Those are the protocols that are allowing value to be networked and accessed by ordinary people. And that's the significance of the Satoshi Nakamoto white paper. The first protocol, not too different than HTML, not too different than Bluetooth, to allow value to be put on digital networks. So once again, what is crypto? It's architecture. It's computer protocols using distributed ledger technology and cryptography to record ownership and transfer of value on the internet rather than as assets and liabilities on the proprietary balance sheets of roughly 7,000 commercial financial institutions. What do I mean by that? Well, if you think about the way in the 20th century, and it only goes back about 3 or 4 centuries, we record value, it's kind of strange, isn't it, on the balance sheets of proprietary commercial institutions. Whatever I've saved up for retirement is not stacks of $100 bills at Fidelity in their vault. It's an IOU on Fidelity's balance sheet. Think about for a second, why do we record how much wealth you've saved, what's in your checking account? Why do we record that on some individual financial institution's balance sheet? With 3 of our country's largest ones just failing in the last year, and financial institutions failing all the time. Why are we not recording value on immutable ledgers like the internet, which in 30 years has never gone down and gets stronger with every PC sold in America? That's the premise of crypto. A new architecture of recording value completely different than the way we've been doing it ever since the Bank of Amsterdam in 1670 said, put your Dutch guilders in our vault and we'll give you an IOU you can take down to Venice and trade with. That's the beginning of our current system. And crypto is the beginning of our next financial system. And growing out of this notion of recording value on digital networks are all kinds of innovations. And by the way, we're still in the early innings of this. From digital commodities like Bitcoin, to digital securities, to stable coins, to central bank digital currencies with over 130 countries around the world looking at their own sovereign digital currencies now. And DAOs and computing protocols and DeFi and smart contracts, none of which am I going to go into today because we don't have hours and hours of time. But I want to leave you with this notion of crypto as architecture. And tokenization, the breaking down of unit blocks of value into individual transferable tokens to which each of us can have direct access rather than through intermediaries like banks and financial institutions. So the vision is all forms of value being tokenized and placed on digital networks. And Aaron was earlier talking about music as a value being placed on digital networks. Well, that's just one use. From all kinds of digital collectibles and software licenses, reputation, identity, title to our automobiles, title to our houses, so many things of value being taken out of recording on individual balance sheets and placed on global ledgers. So what is the reality? Where are we today in the private sector? And I'm going to come to the public sector in a minute. Well, the United States had early technological leadership in this innovation and an early dominance in dollar-based stablecoins and layer 1 blockchains. But we've also seen spectacular commercial failures, as I believe Aaron mentioned before, like FTX. And we continue to see large retail trading fraud and manipulation, money laundering and tax evasion. And importantly, a lack of US-based legal pathways to broad-based commercial success. And as a result, we're seeing migration to overseas legal jurisdictions of the United States' early technological leadership. And yet, despite that, Bitcoin continues to rise in value, utilization, and computing power. Now, I want to lay out for you an analogy of thinking about where we are in the context of American history. Prior to the coming of the railroad and the transcontinental railroad, the United States was not a national economy. We were a series of isolated regional economies, the East isolated from the West, the North isolated from the South. It was the coming of a brand new technology, railroad technology, that allowed a continent of disparate economies to become one national economy, the likes of which the world had never seen before. The railroad was a fundamentally new transportation technology that replaced steamship and sailship and horse and carriage. And yet, the mania for railroad stocks led to some of the worst fraud and manipulation we had ever seen in this country. The likes of Goulds and Vanderbilts manipulating the price of stocks, manipulating the sale of stocks, outright fraud and manipulation. And yet all of that did not undermine in any way the fundamental transformative nature of that technology. And I think that's the analogy for today's Internet of Value. This is a transformative technology. And as earlier transformative technologies have shown us, accompanied with a fair amount of fraud and speculation, preying on society's excitement for this new technology, but not, at the end of the day, not undermining it. What we do need, of course, is good regulatory frameworks, which we have not seen with one exception of the CFTC heretofore. And as I mentioned earlier, Bitcoin fundamentals continue to get stronger despite all the fraud and manipulation, whether you look at the adoption rate, the hash rate, which is the computing power, or the execution rate. And institutional and corporate interest in crypto continues to grow with the likes of major names like BNY Mellon, State Street, Goldman Sachs, JP Morgan, BlackRock, Fidelity, et cetera, et cetera. I'll give you one other analogy, and that is the 2000 dot-com bubble. I'm looking around the room. There are a few other gray hairs or no hairs like me here that remember the 2000 dot-com bubble. It was a poster child company called Pets.com that failed during it, and I think it was Time Magazine did an article. They called it dot bomb, and they basically said that's it. E-commerce is never going to happen. Well, in 2000, when Pets.com failed, there was less than 360 million users of e-commerce. Pets.com did not fail because people didn't want to buy pet supplies online. It failed because they didn't want to do so using dial-up modems. They didn't want to enter their credit card information into some dodgy website. And they didn't want to wait 3 weeks for the pet supplies to arrive. The pets might have died by then waiting for the pet food to come. Well, it took the development of Amazon. It took the development of eBay. It took the development of PayPal. It took the development of Amazon delivery. It took the development of 4G and 5G technology to make e-commerce a reality. And it did. By 2010, the number of e-commerce users had grown to almost 2 billion. And by 2020, 4 years ago, it was over 5 billion. It's probably 6 billion today. The world has embraced e-commerce, notwithstanding the first wave of failures. I think the same is true about crypto as a new architecture of finance. Now let's talk about public policy, today's reality under the Biden administration. What I would call is abject regulatory hostility to this new innovation as a policy element. It starts with regulation by enforcement, largely by the SEC. The refusal to develop regulatory frameworks which are appropriate for this innovation. Now, I've heard it said there's nothing wrong with the old frameworks. We don't need a new one. Well, if that's the case, then why do we have unique frameworks for municipal securities? Why do we have unique frameworks for bonds as opposed to equity securities? We already have unique frameworks under the SEC's rule sets, and there's no reason why we can't have a unique framework for crypto assets put out by the SEC, and I think we will eventually get that. But over the last 3.5 years, the failure for unique frameworks and the regulation by enforcement has created a general hostility to crypto asset innovation. And we've seen from the banking regulators something that looks a lot like something that was present during the Obama years, Operation Choke Point, to starve banking services for industries that the administration didn't like check cashing and others. Well, we've seen a similar environment for crypto banking. Very, very difficult for nascent crypto service providers to be able to get banking services. And what that's done is resulted in U.S. entrepreneurial innovation to move overseas. From our early lead, we've lost a lot of development power. The venture firm Electric Capital does an analysis every year of engineering talent in crypto. And they've shown the amount of U.S. domestic engineering talent has dropped over the last 3 years in favor of our overseas economic adversaries and our overseas economic competitors. And it also means an absence of U.S. global policy leadership at international conclaves where standards are being set for digital innovation. Now, the House has had success in passing crypto legislation, the Fit for the 21st Century bill known as Fit 21, and there's a lot of good in that bill. I think there's still some issues that need to be resolved, but it shows momentum for developing unique regulatory frameworks for crypto. Unfortunately, Senate action, there's some very good Senate action, but it hasn't moved forward. So we don't have congressional legislation yet. I'm hopeful that we will in a future Congress. Now, I said before that I thought during the Trump administration, some very good work was done at the CFTC, including the launching of the world's first Bitcoin futures market, creating the world's first digital commodity priced in dollars. And I think that alone is a good argument of why Donald Trump could be considered the United States' first crypto president. But what we're seeing now, the promises that are being made for a second Trump term are quite impressive. First of all, it's the first ever presidential campaign to accept donations in cryptocurrency. But here are just some of the statements over the last few weeks that have been made. Stop Joe Biden's crusade to crush crypto. To keep Elizabeth Warren, quote, and her goons, not his words, not mine, away from your Bitcoin. To ensure that the future of crypto and Bitcoin will be made in the U.S., not driven overseas. To support the right to self-custody to the nation's 50 million crypto holders. To ensure every American has the right to self-custody their digital assets and transact free from government surveillance and control. To never allow the creation of a central bank digital currency. Defend the right to mine Bitcoin. And I think just in the last 24 hours, the appointment of J.D. Vance as a running mate who has been notably positive on crypto, some of his online lectures shows a real familiarity and a real appreciation for this asset class. Amidst all these statements, I discern two principle-based reasons for a potential Trump administration to truly embrace crypto and not just have these statements out there to attract voting. One is, if Trump's been consistent on one thing from the beginning, it's been the need for economic growth in the United States and innovation to take place here. And that's true in his statement that the future of crypto and Bitcoin will be made in the United States. The second principal reason is, I think, an affinity for, at the heart of populism, returning power to individuals over central control. And the premise of crypto is not, and there's nothing in the Satoshi Nakamoto white paper that ever says it should be free of regulation. But it does say it should be free from centralized control by large financial institutions. And I think that the notion of crypto, and certainly J.D. Vance is talking about this, as returning direct access to one's financial resources without having to go through intermediaries, having direct access on a blockchain, is one of the core principles why I do believe that in a second Trump term, should there be one, that crypto truly would face a support and not hostility from the administration. And I think the creation of true legal frameworks. One of the things, by launching Bitcoin futures at the CFTC 6.5 years ago, a market that today is deep, it's liquid, it's transparent, and it's well regulated, we showed that American regulators can engage with crypto and engage successfully if they have a mind to do so. Now, unfortunately, over the last 3.5 years, that same will hasn't been there. But I think it's very possible that in a second Trump administration, that will would be very much there to develop those frameworks that are necessary for this new architecture. I truly believe that the 21st century will see a kaleidoscope of digital systems of value. Some of them will be decentralized like Bitcoin. Others will be highly centralized. Some of them, those centralized systems, will be sovereign, run by governments, a digital euro, a digital Chinese yuan. And others will be highly centralized, will be run by commercial entities like stablecoin operators, USDC and the likes. Now, these centralized systems of value, these centralized ones, are going to cache massive amounts of data about the economic and financial activities of users. And there's going to be enormous temptation for big tech and government surveillance, censorship and control, a violation of both human rights and our constitutional rights. And the concern is similar to the US government's ongoing coercion of social media platforms to censor speech that the government doesn't like. The same concern about central bank digital currency monitoring our financial activity is true about stablecoins monitoring our activity as well. So how do we make digital currency safe for democracy? Whoever our next president is. Well, I think we need to reflect on the fact that yesterday, the US led the free world in insisting that that first wave of the internet that I talked about, that internet of information, was one that was an open architecture reflecting the values of free societies rather than closed and repressive ones. It was the United States that made sure that the first wave of the internet was one that closed societies like China couldn't control. And we did that both by direct influence, but also creating the institutions like ICANN and the Internet Society that stood for those principles. Well, where are we today in a new wave of the internet? An internet of value? I believe a good start was made 4 years ago by the Trump administration by addressing crypto and the internet of value as we did at the CFTC. But over the last 3.5 years, I believe the Biden administration has abdicated that U.S. early leadership in the accompanying internet of value. So I believe tomorrow, should there be a second Trump administration, but even if there's not, whoever the next president is, the U.S. must lead in building domestic legal frameworks and then setting global standards for digital networks of value, both sovereign and non-sovereign, both CBDCs and stablecoins that are worthy of individual liberty and human rights. So here's my call to action. This value, internet of value, will not be stopped. It can only be directed. So let's not be intimidated, but invigorated to harness it for good. And let's set legal frameworks and standards for digital currencies, both CBDCs and stablecoins, sovereign and non-sovereign, that are worthy of democratic society. And people everywhere, not just Americans, people everywhere who aspire to true financial freedom.